Something very interesting and important is happening in the markets right now. Let's call this the WBI, wonky but important. Okay, bear with us here. This line is the gray one, the blue one. It is the line on the 10-year Treasury. The other one is the MSCI All-World Stock Index, okay? Very broad measure. You can see for most of the last year, they were tracking in roughly the same direction. But look at recently. We're seeing the MSCI World Stock Index go up while yields on the 10-year come down. A big divergence right here. What is that telling us? Jeff Kleintop is the Chief Global Investment Strategist at Charles Schwab. And Jeff, we pulled this chart out of your notes, so thank you for bringing it to us. What different stories are these two things telling you right now?
Yeah, it's wonky but important, right? The stock market seems to be rallying on the idea that some of these headline issues, let's call it maybe fewer concerns over Brexit going a bad way, maybe on a trade deal. Those news headlines are lifting the stock market, giving investors optimism there that growth is going to rebound, both in the economy and earnings. The bond market doesn't see it that way, very focused on the data, which continues to be to the softer side, both for earnings and the global economic picture. Historically, Brian, bonds tend to get this one right. So I'm worried that gains in the stock market may be limited from here.
All right, let's go back to the chart here because, yeah, they tend to track similarly, but there was a period in the fall where they started to diverge just a bit, Jeff. Again, bond and stock markets telling different stories, not necessarily to the magnitude recently. What makes you so confident that bonds and, you know, the credit people who like to believe they're smarter do have it right?
Well, credit conditions are incredibly important in these latter stages of the cycle, and the bond market seems to be focused on that. But even more so, I think some of the things that have helped support this rally, like the burgeoning trade deal between the U.S. and China, really aren't the root cause of global economic weakness. Not even in China. For example, export growth from China is up 9% year over year through January. Trade hasn't been a problem for Chinese growth. It's much more focused on things like tighter credit conditions, which may be lingering here this year and further slow the world's second largest economy. So I think the stock market has taken optimism from some headlines that aren't really the root cause of weakness, and the bond market is instead focused on those root causes which have yet to change.
Is the stock market wrong?
I'm afraid it. Look, the rally so far this year does make some sense. Stocks maybe went a little bit too far in pricing in the start of a global recession late last year. So certainly getting some rebound there. But I'm afraid as we look out over the next 12 months, there might be more risk to the downside than the upside from here.
How much risk?
You know, it's difficult to say. I think one of the things that I think there's probably a greater than 50% chance, but I think one of the things that could change that outlook and make me more optimistic on the stock market is the start of a tax war, not a trade war, but a pro-growth tax war. Germany's talking about cutting corporate taxes. So is the UK, the Netherlands, Australia, Canada, many countries following the lead of the US. That would turn around the trajectory of earnings estimates and really cause maybe a brighter outlook as earnings would then support higher valuations. So that could change and is potentially something on track for the second half of this year.
Do you think that's why the globe has done well in part, that optimism over that so-called tax war that you talk about, Jeff?
A couple of reasons. One, I think, yes, there is some idea that there might be more stability or maybe even more upside to earnings than maybe what we'll see in the U.S. this year. The other is the fact that valuations overseas in the EFI countries and certainly in emerging markets are well below those of the U.S. and in fact wider than their 15 or 20-year average. And so that would suggest that already lower expectations were baked into those markets.
You know, Schwab clients, they were probably scared in December. You guys putting out notes to sort of soothe that. The markets have come back up. What are you advising clients to do right now, Jeff?
You know, take a look at your portfolio. You may be a little bit more overexposed to cyclical parts of the market, things like industrials, which have led the market this year. But take a look at other sectors, maybe like healthcare. Healthcare is probably less vulnerable to a potential slowdown later this year, given its earnings are less economically sensitive. That might be a place to consider as you reorient your portfolio to what might be a more difficult environment for the remainder of the year.